You know that one piece of financial advice you've heard a million times? The one that's supposed to be the absolute gold standard for retirement? Well, what if I told you that for almost everybody, that path doesn't lead where you think it does? Okay, let's really dive into this. For decades, the go-to mantra has been buy term and invest the difference, or BTID for short. The logic seems totally sound, right? Get some cheap insurance and pour the rest into the stock market. But if this advice is so good, why isn't everyone a millionaire? I mean, is this really how wealthy people build their fortunes, or is there a whole other playbook that most of us just never get to see?
So get this, Fidelity, the single biggest 401k provider in the country, ran the numbers on their own customers. And that number you're looking at, 2.43%, that's the percentage of their millions and millions of participants who are actually millionaires within their 401ks. Let that sink in for a second. Less than 3 out of every 100 people who are doing exactly what they're told actually make it.
That number right there should make you stop and question the entire story we've all been sold. This really brings us to what you could call the millionaire myth. So we're going to pull back the curtain on the 401k reality and see what the data is actually telling us about this whole strategy.
Okay, now this is fascinating. This chart just lays out the massive disconnect perfectly. On the left, you see the result for the average person diligently saving in their 401k for 30 years, about $430,000. Now that's a decent sum for sure, but it is not $1 million. But look at the right. That's the average balance for the tiny few who did become 401k millionaires. It's nearly 4 times higher. This huge gap proves that just saving inside this system doesn't automatically get you to the finish line we're all promised.
So why the huge gap? Well, the whole buy term and invest the difference idea looks fantastic on a spreadsheet, but it completely falls apart in the real world. You know why? Because it assumes you're a robot. It assumes you have perfect discipline for 40 straight years. But life happens. Markets crash, people lose their jobs, medical emergencies pop up out of nowhere. People don't always invest the difference, or worse, they panic and sell their investments at the absolute worst time.
And that leads us to the next point. The problem isn't just about human behavior. It's actually baked into the very architecture of the system itself. There are hidden structural flaws that hold most people back.
So here's the crucial point. The traditional BTID model has a built-in structural ceiling. It's limited by 3 key factors. First, what we call mandatory illiquidity. Your money is basically locked up until you're 59 and a half, with huge penalties if you dare touch it early. Second, tax friction. Your growth is tax-deferred, which sounds good, but all it really means is you're facing a potentially massive and unpredictable tax bill when you finally need the money in retirement. And third, and maybe most important, a fundamental lack of control over your own capital.
And this table just illustrates the difference perfectly. With the old BTIS strategy, if you want to access your money, you often have to sell assets or take a penalized withdrawal, both of which are painful. Your growth is tax-deferred, which just means you're kicking a tax time bomb down the road where rates could be even higher. Now contrast that with the FBC Plan's architecture. It offers tax-free access through loans and tax-free growth. Plus, when you borrow and pay yourself back, you recapture the interest that would have just gone to some outside bank. It's a completely different universe.
So, if the old advice isn't working for 97% of people, what does? Well, the answer isn't about saving harder or picking a better mutual fund. It's a total mindset shift. It's about owning. This is the real path to wealth.
This quote from Forbes just hits the nail on the head. Becoming wealthy isn't some clever savings trick. It's about owning assets that you actually control, assets that work for you, like a business or a piece of real estate. It's about moving from being a passive saver to being an active owner.
And the data backs this up, 100%. If you look at how self-made millionaires actually build their fortunes, it's overwhelmingly through ownership. The biggest slices of this pie are business ownership and real estate. Yeah, sure, public stocks are in the mix, but they are rarely the main engine driving the train. The real wealth is in the things they can actually control.
Okay, so that brings us to a completely different way of thinking. It's a framework called the FBC, or Family Business Circle Plan. And it's really important to think of this not as a product, but as a financial architecture, one that's built on those exact same principles of ownership and control that the wealthy have always used.
The FBC framework is really built on 2 core parts that work together in harmony. First, you have a family business. This is your engine for generating wealth, and it acts as a powerful tax shield. And second, you have a family bank. This is where you store, protect, and control that wealth. It's a powerful integrated system.
Let's just zoom in on this family bank idea for a second, because it's the engine of the whole system. Essentially, it's a specially designed high cash value whole life insurance policy. It's engineered from the ground up to be your own private source of capital. The money inside grows shielded from taxes, and you can access it whenever you want, tax-free through policy loans.
So this is the old world. Under the buy term and invest the difference plan, if you need cash for an emergency or, heck, an opportunity, your options are terrible. You either have to sell your assets, which triggers taxes and means you lose control, or you take a penalized withdrawal from your 401k, which also costs you dearly. It's a lose-lose.
Now contrast that with the FBC plan. When you need cash, you simply take a tax-free loan against your own policy. You don't sell a thing, you don't pay taxes on it, and here's the best part. The original asset, your cash value, continues to grow and compound as if you never even touched it. You get to use your money in two places at once. It's a total game changer.
When you really take a step back and look at all this, you realize we're not just talking about two different strategies here. We are talking about two completely different financial worlds, built on totally opposite philosophies. It's about choosing which world you want to build and live in.
And this slide just sums it all up beautifully. The BTID plan is an external, fragmented system where you hand over control of your money to Wall Street and the banks. You just cross your fingers and hope the market goes up. The FBC plan is the complete opposite. It's an internal, unified system, a personal economic fortress where you control the money, and that money is always working for your family first and foremost.
So, this whole thing really comes down to one final question, and it's the only one that truly matters. After seeing all this, you just have to ask yourself, are you just building an investment account and hoping for the best? Or are you intentionally designing and building your own economic fortress? Because that choice, well, it determines everything.